Hi everyone, welcome to my YouTube channel, and this video will be on Introduction to Ratio Analysis. This will be part 1 of a series of videos, and I hope that through this video I'm able to share with you how we use ratio as a tool to study financial statements, right? And hi, once again, I'm Wildy. Actually, I manage this YouTube channel, and I hope that this will be informative, and do watch out for my part 2 of this series of ratio analysis. Let's begin. Right, so what we're going to do today is that we're going to look at the use of financial statements and the purpose of ratios. How do we use ratios to study financial statements? And thereafter we are going to see, understand how these ratios help us to understand financial statements better. And following that, right, we are going to look at what's the purpose of ratio analysis, and how do we read ratios with, understanding. Ratios on their own, and I would like to make it clear, they are not the only means to an end, right? They are one of the many means to help us achieve a good understanding of what the financial statements tell us about a business, right? Now, and we'll end off with the second last point, which is to look at how we report financial results. But because of the length of the video, we will not be able to go through a full comprehensive walkthrough on how we report financial results. I'll try to do that, on how we could report financial results later on, but it will not be in this video. And finally, to end off, we'll look at what are the various limitations of ratio analysis. Right, from time to time I will cover a bit of the limitations. So hopefully that would give you good insight and good understanding of this topic of ratio analysis. This video will be applicable to students taking the ACCA, the FIA program, as well as students who are taking the diploma and degree level programs. Okay, so what do we use financial statements for? Financial statements basically are summary of the financial position at a point in time. And how we understand the financial position of business is through the statement of financial position. The statement of financial position shows us whatever the business has, whatever the business owes, but only at a point in time, right? The financial statements also include one more very key item, which is known as the income statement. The income statement is very crucial because it shows us how the business has done, right? How well were resources used to generate revenue, and how were expenses arising to generate all this revenue. So it gives us a good idea about the financial performance over a period of time. Another very key part of financial statements is the cash flows. It shows the cash flows over a period of time, and how cash flows are being used for operating, how cash flows are generated from operating activities. It shows us also cash flows to and from investing and financing activities, right? Now, the issue with financial statements is that the information provided in it is heavily summarized. It becomes kind of, restrictive. It doesn't give us as much information as we would want. Certain important relevant information might be omitted, right? So when you look at the financial statement, it is very difficult, to point your finger to say that, that's relevant, because there might be something else more relevant, but these happen to be omitted, right? Now, and the next thing is that looking at financial statements isn't going to give you a complete picture of what the business is about, or how the business has been doing. You will need to actually have a good understanding of the underlying business in order to understand why the financial statements show whatever it is showing, right? And remember, you can't have a good understanding of the business, and I repeat, unless you read the financial statements together with your knowledge of what the business is about. Together, then your understanding of how the business is doing is complete. And next is that, common mistake made by many people is that, or many students is, when they analyze results of businesses, or even from period to period, they are not able to appreciate the fact that another cause of variances in performance, or variances in results is due to accounting policies. Accounting policies do affect how the results are derived. And and you won't be able to understand the implication of accounting policies just by looking at the financial statements. It's much deeper than that. And unclear financial statements unclear financial policies that are being used, accounting policies that are being used, actually makes it very difficult for users to have a thorough and clear understanding of how the business did and how the business is at a point in time, right? So accounting policies themselves is a problem. When you compare results of two companies, you have to remember the results are derived, in part due to the policies that are set by the management. So differences in policies are bound to make it a bit difficult, challenging perhaps, in how we study the financial results of companies and also over periods of time. Now then, this leads us to the next issue, that intercompany comparison becomes tough and really quite challenging, and you could say that it's not meaningful because there are so much differences in accounting policies and treatments. Different policies and treatments results in different inventory values, different asset values, and different liability values, and the differences in the computation ultimately flows into the financial statements. And as a result, your financial statements of one year and another year may not be readily comparable. Even if you want to compare, it becomes quite meaningless, right? But yet we still have to try to make sense out of financial statements, right? Because that's the primary tool of communicating results to users, stakeholders of the business, right? And ratios still remain, although it's quite limited by various shortcomings, it still remains a very commonly used tool, right? However bad the restrictions are, we still use them widely, right? So let's look at a very quick introduction on the purpose of ratios. Ratios are very useful because it helps us to put more meaning, infer more meaning from the financial results of a business, right? Because just by looking at the results of two businesses or maybe two periods just like this, you might have the idea that, hey, the revenues improved over the period of time. You might think that, okay, that sounds good, right? And by looking at the gross profit, you might think that, oh, that sounds better because the dollar amount of gross profits have improved, right? But ratios give us one more additional dimension of understanding. Watch. If you were to calculate a very simple percentage, gross profit divided by sales, right? Don't you think that this gives us better understanding? By performing this computation for both periods, it shows us that, hey, the company's gross profit margin remained the same from 2013 to 2014. So is there any concern? Well, you could say that business as usual, the business has been doing the same, selling the same, so therefore the margin should be constant, right? So it is quite useful in a sense when you look at the ratio, because it shows you the relationship of two values, in this case gross profit and sales. By that, you can tell that the reason for the increase in margin is because there are more sales. It's not because that the business is selling even more profitable products. It's not. It's just that there is more volume. More volume resulted in more margins, or if not, more sales resulted in more gross margins, right? However, profitability has not necessarily improved. Now, something? By looking at the income statement, we also could use ratios to understand, that even differences in terms of accuracy and reliability can also affect how we analyze the performance of a business from year to year. But in this case, the figures here are exactly the same as the earlier slide. Observe, it's exactly the same. The difference is that closing stocks have been slightly adjusted lower. No, it is not uncommon for businesses to have different ways of recognizing inventory values, or different ways of valuing inventory. Some may value their inventory more conservatively, and that may result in smaller or lesser lower inventory values. So as a result of different inventory valuation, that may also affect, as you can see here, margins. Margins are immediately affected just because businesses have slightly different policies, approaches to, let's say in this case, inventory valuation. Now, it might be the same stock that we are looking at between this illustration and this illustration. The inventory might be exactly the same, but the method, the approach, the policy is different. So then that immediately affects the result, the figure that is being reported in the income statement, and that immediately affects the gross profit margin. Now, then as a user, how would you be able to understand ratio properly? Well, one thing is that you have to understand the accounting policy. If not, you won't be able to understand why the financial results are fluctuating as such. Now, I'm not going to talk more about policies, but I'm going to also add on that policies, especially accounting policies and treatments that are different, all these don't just affect the income statement, they affect assets and liabilities as well, right? Now, there are so many standards that affect all these assets, liabilities, income and expenses, right? Quite a number of them, but they are not in our discussion here. So the question is that with all these different policies and treatments of the different companies, do they affect the way we study ratios? Do these affect and even make ratio analysis redundant? Now the answer is of course no, because ratios still remain the most convenient, most accessible way of studying the financials of a company. So having known, having this thing in mind, that the differences in policies and treatments do affect the results, you will have to study ratios with that in mind. You can't study the ratios as they are. You have to study together the policies and treatments, right? Then that will make your understanding of the results and how these results have varied from year to year meaningful. So ratio analysis can be performed on different aspects of the business, and this allows us to quickly understand the business in terms of its profitability, liquidity, activity, and gearing. We have looked at profitability. Profitability ratios refer to ratios that measure, profitability, right? Commonly used ratios that measure profitability include the return on capital employed, which we simply take the operating profit and then just very simply divide by, and then we take that and we divide it by capital employed. Simple. And we multiply that by 100. Now the usefulness of calculating the return on capital employed is that it shows the return on whatever capital that the business has utilized to generate the profits of the business. So this capital that may be obtained by the business includes equity and as well as debt capital. But obviously a higher amount of return on capital employed means that the business is able to generate greater returns for its equity and debt stakeholders. Net profit margin does look at the profitability from a different point of view. Simply put, this takes net profit divided by sales, or some would say net sales multiplied by 100. So this measures the profitability of the business after deducting for all expenses, right? So obviously, if a business is not able to achieve a positive net profit margin, it means that it has, it may have potential going concern issues. Potential, not necessarily that it will have going concern issues. So a normal operating business which is profitable should have a positive net profit margin. Now the gross profit margin does a bit different. Instead of taking the net profit, we take gross profit, and what we do is that we divide that by sales multiplied by 100. So this gross profit is derived by taking sales minus cost of sales. Now, the purpose of gross profit margin is to determine the profitability of the trading activities of the business. But this has not taken into account things such as selling expenses, admin expenses, and other expenses not related to, the buying and selling of goods, not related with the trading activities of the business. So, gross profit margin, rightfully, therefore, will always be greater than the net profit margin, right? Now, as for what is the ideal percentages for all these, it all depends on the industry. Certain industries might have higher gross profit margin, some may have less, right? And also depending on, like the type of goods that are being sold, right? Which is why for you to be able to study and understand these, you need to know what business you are, analyzing. Okay, we go on to the next one, which is liquidity ratio. The liquidity ratio is commonly measured, right, on top of profitability, because it measures the ability of the business to meet its short-term current liabilities. Short-term current liabilities include tax liabilities, liabilities for inventory purchases, right? Obviously, a business which is able to meet all those short-term liabilities is considered, going to be a going concern, at least for the near term, right? So the calculation, we use mainly two ratios to calculate liquidity, to measure liquidity: the quick ratio and the current ratio. The quick ratio, which is calculated by taking the current asset minus the inventory or stock over current liability. Liabilities if you have many liabilities, right? Current assets if there are many assets. Current ratio, which is calculated by taking current assets over current liabilities. So the calculation is fairly simple. Now, how do we interpret this? The current ratio is calculated using current asset divided by current liability. Typically, it's expressed as something is to 1. Now, there are many, sources or many writings which have proposed that the ideal level should be 2 to 1, right? But some have even proposed that it should be 1 to 1. Now, how do we read this? A 2 to 1 means that every $2 of current assets there is only $1 of current liability. In such a case, it means that the business has no difficulty in paying off its current liability, which is obviously a good thing. Now, how about 1 to 1? For this case, it's also desirable, because it means that every $1 of current liability there is $1 of current asset. Right, that is also fine. What about 100 to 1? That's fine too, because it means that there is absolutely no problem paying off the current liabilities. Now then, what is the ideal level for the current ratio? The answer simply is that there is no ideal level, right? It depends totally on the industry. Certain industries may operate with 1 to 1, some may operate 2 to 1, some may operate higher, right? So it depends very much on the industry. There is no such thing as an ideal level of ratio. This doesn't exist, right? Industry normal, yes, there are, right? So I hope that you bear that in mind. I have marked many assignments, and students do tend to give the answer that it has to be 2 to 1, and that is the ideal level. No, there is no ideal level. It depends on the industry, right? Now let's go on to the quick ratio. The quick ratio varies a bit from the current ratio. The difference here is that we subtract stocks from the current assets, or we exclude stocks. The reason is because stocks are not as liquid as it seems. Stocks do take time to liquidate, do take time to sell, so that the business is able to recover cash, right? The way we interpret quick ratio is very similar. We express the answer as something is to 1, right? We interpret this in the same way. If you have a result of 2 to 1, it means that the company has sufficient quick ratio. If it has 1 to 1, what does it mean? A 1 to 1 quick ratio also means that the business has sufficient liquid assets to cover the short-term liabilities. So, is there also an ideal level for quick ratio? The answer is that there is no ideal ratio level for quick ratio. There is no ideal level, right? Businesses may have slightly less than 1, they might have 0.98, 0.8:1, but it doesn't matter, right? It all goes back to the nature of the industry. The nature of the industry is going to determine, or will determine, what is the ideal level, or maybe it will define what is the appropriate level for the industry. So industries may, different industry may operate with 1-to-1 quick ratio, some may operate with 1.2-to-1. It really depends, right? It depends on what business they are in. It depends on what goods and services they are providing, right? So reading this is not as simple as, as to look at, oh, it's greater than 1-to-1, it must be good. No, it doesn't work that way, right? Very common mistake that a lot of students have done is that they've written that the current ratio higher is better. Now, I'd like to emphasize that this is wrong understanding, right? A very big implication here is that a very high current ratio or quick ratio is a potential problem. Like, let's say 100-to-1. What does it mean? It means that the business has too much liquid assets stuck in current assets. Now, liquid assets may refer to cash, especially cash. When you have a big current ratio, it means that there is a lot of cash, lying in the bank account, which is not healthy, because a large amount of cash lying in the bank account means that you're not properly utilizing the assets to generate a return, right? And say maybe 100-to-1. 100-to-1 means that there are probably a lot of idle liquid resources. Now, that is unhealthy, right? A high current ratio is never a good thing. It means that the business is being very wasteful in the use of its capital. So goes the same for quick ratio. A high quick ratio means that there is too much idle liquid resources, right? And to understand this better, I'll encourage you to practice some of the questions from the accounting textbooks. Those will give you a good grasp of this topic. Or even better yet, take an actual annual report and try to study the liquidity. That helps too, right? Now, what other ratios we calculate? Okay, we also calculate the activity ratio to study how efficient are the assets of the business being used. So one of them is the asset turnover. Right, asset turnover, which is calculated by taking the sales of a business divided by the non-current assets of a business. The usefulness of this asset turnover is that it shows how efficient is the business using the non-current assets in generating revenue. Now, a high non-current asset or a high asset turnover is, to some extent, good news, because it means that assets are being utilized, right, efficiently. But a high asset turnover may not be a good thing, right? A high asset turnover may be indicative of certain issues such as overcapitalization, right? Overcapitalization is not necessarily a good thing for a business. Well, that is another topic. We'll talk about it another time, right? So, for the asset turnover, high is not necessarily a good thing. So is low. Low is not necessarily good. Low means that obviously the business is not properly utilizing its non-current assets to generate revenue. Okay. Also quite key in many business is receivable collection. Receivable collection is very useful because it measures the average time taken for the business to collect back whatever amounts due from debtors. Right, this is simply calculated by taking the average receivable divided by credit sales. Pardon me for the short form, or pardon me for the abbreviation. Right, it's calculated by taking average receivable divided by credit sales multiplied by 365. The usefulness in this is that it shows you the efficiency in the collection process. Right, how efficient are the credit policies. Now, a long collection period is necessarily indicative of high risk of doubtful debts. A short collection period is also shows something else. It shows that the business has very tight collection policy. Is it good to have a short collection policy? Yes and no. Yes, because it improves the liquidity of the business. Bad, because it means that customers are pressured to pay early. Right? So it is very difficult to say that shorter is better, longer is better, because both of them have their own potential problems. Inventory turnover or inventory holding period. This is calculated by taking the average inventory divided by the cost of sales multiplied by 365. The usefulness of the inventory holding period, okay, it shows whether there is issues with overstocking, right? Whether there is whether stocks are quickly turned, right? A short stock turnover period is ideal because it represents efficient stock management. A long stock holding period may be bad because it shows that there might be excess stock being held. But wait, it also depends on the industry. Certain industries will have long stock holding because of the value of the stocks, such as furniture, such as electrical appliances. Certain electrical appliances are have very high dollar value. So you do not expect people to buy, let's say, a set of sofa every day, right? So given that furniture shops will tend to have relatively longer stock holding period compared with, let's say, a supermarket. Supermarket, of course, they will have much shorter holding because of the fact that food is perishable. Payable payment period, right? Now, payable payment period can be calculated for raw materials, inventory, calculated for things such as labor, wages, and things such as overhead costs, right? This can be calculated by taking the average payable, divide that by the purchase of goods, multiply by 365. The useful thing about calculating payable payment period is that it gives you immediately a good idea whether payments have been delayed, whether they are on time, whether it's too short, right? Of course, if you have a short payable payment period, it's not a good thing. It means that you might not have been making good use of the trade credit given, right? If you have a long payable payment period, it might not be a good thing as well, because it means you might be taking too long to pay. That really will affect relationship with payables and suppliers, right? Gearing. Gearing is an important ratio to measure, right? As an investor, as a business owner, one of the concerns that you might have is that has the business taken on too much borrowing? A business with high borrowing faces real issues with what they call default risk. Default risk means that the business has no ability to pay up and defaults on its loan, right? That is serious. A business that defaults obviously will close down, very soon, right? We say that gearing ratios measure the indebtedness of a business in relation to its level of equity, right? Some ways that we use to measure gearing ratio include capital gearing. Capital gearing simply is also known as debt to equity. We take the long-term liabilities of a business and then divide that by the equity, which simply includes shareholder funds, reserves, and then with the fraction that you have derived, multiply by 100. It can be expressed in percentage terms. Interest cover, simple, is calculated by taking operating profit over interest expense. Right? Operating profit over interest expense. Interest cover shows us how readily the business is able to cover its interest expense. Obviously, a high interest cover is desirable because a high interest cover shows that the business has little issues with servicing its debt obligations, especially in terms of interest. Right. Now, I'd like to also point out one more thing before I move on. That is, are there any ideal ratios for gearing and interest cover? The answer is no, because it depends, as I mentioned just now, it depends on the industry. the type of industry that a business is in will define what is an appropriate level of gearing and what is an appropriate level of interest cover, right? So for you to be able to assess this, then using industry average plays a very important role, or maybe use of comparative numbers from a listed company, which is similar to the company in question. So these help to confirm, ascertain whether there's a chance of high gearing, right, in the company. So ratios are quite useful. It measures a wide variety of things, right? But ratios on their own have very little meaning. They have to be read and understood in conjunction with understanding of the business. Without an understanding of the business, ratios have no meaning. Ratios are basically numbers derived from financial statements. And the only way for these to have meaning and to be able to help users to make decisions is that you have to read them together with what the business is about. And now what we're going to do is that we're going to use a simple set of financial figures, right, income statement and the balance sheet or statement of financial position, so that you're able to see how we study the ratios and make sense out of them. Okay, so here I have 2013 and 14 results of a certain company, right? This gives me the gross profit and net profits for both years. Okay, I also have the statement of financial position, also for 2 years, 2013 and 14, right? And these are the following values, right? So you can see the values. I have my total assets, liabilities and equity. Okay. So based on those, I calculated the ratios and I found that in 2013 I had my gross profit, my profitability ratios, liquidity, activity and gearing, as well as 2014. Now let's have a very close look. Now in terms of profitability, what do you think of the business? Right? From 2013 to 14, we realized that the gross profits have declined. Right? Why would the gross profits have declined? A possible source of that is due to lower margin goods and services. Right, a business that has been dealing in low margin goods and services is bound to encounter problems with margin dilution. Right. What about changes in accounting policy? Yes, that has an impact on gross profit margin. Let's go on to the next one. How about net profits margins? Why is it that the net profit margin has strangely improved? Let's have a look. The reason why net profit margin has improved, if you notice, gross profit margin increased by 80. However, the selling and admin expenses increased by only 20. So you have more gross profit margin than the increase in selling and admin expenses, right? So obviously this will contribute to higher net profit margins, right? So that explains this. Now then, return on capital employed obviously has improved, and this is mainly due to the higher net profit margins, right? Overall, in terms of liquidity, is the business worse off? The answer is no, don't seem like the case. The business is doing fine, right? The current ratio and asset test is way above the level of 1:1. But is this better than industry average, or is it worse than industry average? Okay, we have no idea whether it is higher or lower than industry average. Activity level. Okay, let's have a look at the activity ratios. Asset turnover is fairly constant, right? Slightly lower compared with 2013. Collection periods have improved, right? Possibly due to tighter credit control policies, right? Payable payment period has also shortened. We found that in terms of inventory holding is also shorter, right? So it means that potentially the business may be enjoying better liquidity levels, and it seems like the case. Let's look at the balance sheet and confirm, ascertain if the business has better liquidity position. Well, as you can see here, cash balance has improved marginally. Okay, that seems to show us that the business does have slightly better liquidity. Notice that? So it goes together, right? We have shorter collection period, we have shorter stock holding period, and that must also help us to maintain the level of current ratio and asset test, right? Okay, what about gearing levels? The debt to equity and interest cover, is it worse? Is it acceptable? Okay, seems like the business is reducing its level of indebtedness. It has much lesser debt equity ratio compared with the previous year. Interest cover has improved, and we know why it has improved, because it has lesser debt to equity ratio. So therefore the interest cover must improve. So notice that when I read the ratios, I would refer back to the balance sheet, income statement, and I also relate it to the other relevant ratios, right? So commonly, many students, what they do is that they try to read the numbers as if they are, they are isolated in individual islands, but that's not right. Right? Try to read the ratio as if, how I read, in my example, right? Try to read them together. Remember, ratios are only an end in itself, right? You can't just read the ratio as they are. You have to read them together with the income statement, and then try to interpret how the ratios relate to the other figures in the income statement, right? Try to understand how they are related. So what makes for a good analysis? Good common sense. When you find that the net margins have improved, go back to the income statement, try to understand which part of the income statement contributed to the improved margins, right? Now, do not just point out that the ratios have improved and you just stop there. It doesn't work, right? It's not good enough. You have to go further and understand why the gross profit margins have improved or worsened. Now, and this is where matching the financial results to the ratios matter a lot, right? If the margins have improved, why is that so? Is it because of lower expenses? Is it because the business has better margins on its goods? You have to be able to answer that. Now, and very important and would also be helpful is reading about how the other businesses have been doing. Look at their income statement and compare with the income statement that you're trying to study. This will give a lot better insight, right? I hope that this has given you much insight on how we study ratios, right? And that when you perform analysis on ratios, try to have a broad view, try to understand and think about the relationship between the ratios, okay? Your value add as accountants and finance people is that you're able to see the relationship and be able to explain why ratios vary and how they relate to each other. That's where you are good and outstanding, right? So, I'm Wildy Chia, and I hope that this has been very informative to you, right? Okay, at least it should have given you some idea about what ratio analysis is about. If you need, help, or if you need to clarify the numbers which I have, presented in this video, feel free to email me at wildy231@gmail.com. If not, you can visit my YouTube channel for more videos at www.youtube.com/231wildy. Alright? And I look forward to, making some more videos on this. Hopefully, this will give you better insight on how, ratio analysis should be performed. Right? There is no template, there is no magic to doing it. A lot of common sense, however, is necessary. Right? So I look forward to hearing from you, and watch out for my next video. Have a good day. Thank you.